We've got a weird feeling about this, right? Okay. I can't even work out if we're live. Right. Apparently, we've let ChatGPT off the leash. We're live, and I haven't got a clue what I'm doing, but that's normal. Surrounded by 15 million screens, and I can't work out which one to point. So I'm not going to close this. All right. So, folks, welcome to this week's chaos. No more swearing. Got my bag of 50p's here, and I've lost my screen, so nothing unusual, right? If I get this one right, here we are. What the heck is this? Okay, sorry, nearly swore again. Second up, right. Reminder to myself: no more swearing. Okay, we're good to go.
If you can let me have the share screen as well function.
Mate, you got to put 50p's in. Come on, what is this? You didn't bring your own 50p's in? I think. As it's nearly Easter weekend and everyone's happy in a happy mode. Listen, that's supposed to be a psychic question. You can't ask for it before Anyway, look. Right, I'm trying to get YouTube chat up in the background. That's what I'm doing. I promise I'm not mucking around. So, welcome to this week's TPP. 50p's here. No more swearing. We're live. Co-host Charanjit.
Hello. Hi, everyone.
And we had a viewer's request last week. We were discussing Section 24, rise of interest rates. We weren't discussing rise of ChatGPT. Anyway, that's a different topic. And we got hold of our really good friend, twisted his arm, had a go at him, and I won't say bribed him because he's an accountant. He might get into trouble for that. We've asked him to come in and explain how, as interest rates rise, that is potentially having a double effect on high rate taxpayers, i.e. they're going to have to pay the interest and the tax. But I'm going to be quiet for about 30 seconds. I'm going to hand over to our good friend, Arif Panjani. And just in case you don't know Arif, not only is he an accountant, he's a property investor, and he has more qualifications behind his name than the Russian alphabet. So watch out for that when he puts his initials up, right? Arif, I'm going to be quiet. All over to you, sir. Please enlighten us.
Yes. Thank you very much. It's always a pleasure speaking at your event, Surinda. And thank you again for Charan. Today, although the title would say Property Tax Planning in Crisis, we would majority concentrate on the Section 24 and the implication of it with the rising interest cost around the property sector as a landlord, investor, or developer. Before we go ahead, for those of you who do not know me, just a bit of background. That was me 20 years ago. Things have changed ever since then. So yeah, qualified back in 2008 as an ACCA, and then thereafter I've got qualifications across 6 other professional bodies, and also I sit at the ATT's VAT Commission. But above all, I'm also a property investor and landlord, as Surinder mentioned. So kind of empathize and try and putting myself into the shoes of the taxpayer as myself itself. From the landlord's perspective, the taxes have gone up significantly if you were to look at it from 3 or 4 years before as opposed to what it is now. But what we aim to uncover today is what we can do to mitigate them if we may. So impact of the recent budget, and I won't say the recent as in the last one, but I would say, and I would take you back somewhere in September, October horror shows, where we had different Prime Minister along with the Chancellor, and as a result, yes, the sterling had gone down slightly. Interest rates have inevitably gone up to the extent that the Bank of England base rate, yes, last week itself is 4.25%. I think with that, our inflation rate in this particular country is 10%, which is the highest in the entire European Union. So that says a lot, not only from the interest rate side of it, but also from the cost of living and the overall cost and the squeezing of the expenditures wise on the overall business itself. Then property prices gone down? I would say arguably no, because we are living in Ireland, but perhaps yes and no. It would have at least remained stagnant, if not gone up. And yes, with the interest costs rising, you have the mortgage cost rising, and the profit has gone down. What the worst could happen is the fact that these rising interest costs, as opposed to me paying 2% or 1.89%, glory be those days, as opposed to currently 5% or 6%, the worst is the fact that I can't even deduct those mortgage costs against my normal rental income. So I'm being hit twice. I'm being hit against the fact that I cannot deduct the mortgage cost. At the same time, the mortgage costs have gone up high. What can I do about it is what we're trying to perhaps explore in this particular humble presentation, if you may. Before I go ahead with it, I typically go with a typical tax UK life cycle that a particular UK property would go through with. That's the minimum that a particular property would go through with. It can be more, but highly likely not lesser. Just like a human life cycle, we are born, we are at the childhood stage, we mature, we are young, and then we die. Kind of a similar, resembling what we have gone up with, resembling it to the UK property sector. We eventually could buy the property. We could then have potential rental income from the property. We could sell it or we could keep it. At each of these stages, we would pay those minimum taxes. And what differentiates our industry as a property industry compared to any other industry, if I were to do a business in as a retail or fashion or construction industry for that matter, or any industry, but why a property industry would be different is the fact that at the inception and at the exit level, which is at the buying and at the keeping it level, the taxes that have been imposed into the property sector is completely biased towards any other sector, obviously in a negative fashion. So if I were to perhaps start buying and selling the pens, when I buy a pen, I do not pay any tax. Yeah, you could arguably say I could pay a VAT, but that's not a VAT I would pay. It's the end consumers who eventually would pay. I would claim the VAT back. However, if I were to buy a property, we all know we pay a tax at the very outset. So just to enter into the market, we have to pay a tax. Forget about making any money out of it. And then when we exit the market, or even if we do not wish to exit the market, which is the inheritance tax, the only industry where we've been targeted by keeping the properties as a 40% inheritance tax as opposed to a pen business. If I were to convert this into multi-million and say the business now was 2 million, and if I were to die, there would be no inheritance tax on this £2 million business. However, if I were to replace this pen with the property, and then these properties that I have worth 2 million, that would be subject to inheritance tax. So a clear differentiation on the incept at the entry and the exit level on the business side, but also within the income tax and the capital gains tax as well. But today we would just concentrate more onto the income tax. So just by giving you an example, before I concentrate on the income tax, is if you were to buy a property, say worth 100K, you refurbish for 50K and your market value is now 200K, you'll be thinking,
pound. But have you really made a profit of £50,000? Because you would have inevitably paid stamp duty land tax at 3%. And if you would have sold the property, you would have paid the capital gains tax at 20%. So all in all, if you were to sell it, you're going to pay £17,000 in taxes, which is one third in taxes. Or worse, if you were to keep it, you're going to pay £20,000 because 40% is the sweet inheritance tax that will be penalizing it for if you were to keep it. So it's quite high. The stakes are quite high. Your net pay home, what you could take after paying taxes, which is your hard-earned money, are getting lesser and lesser in the property industry. And this is just a brief as to what the biases are onto the stamp duty land tax. So before we could have more profit into our pocket, if you were to just be in the business of flipping, buying and selling. But now if you were to be in the business of buying and selling properties, you are paying more and your take home will be lesser because the stamp duty land tax have gone up since April 2016. Again, roughly on the capital gains tax, the bias is clear. So if I were to sell a pen, I would pay 10%. But if I were to sell a property, a residential property, I would pay either 18% or 28%. Again, it's more leaning towards collecting more and more revenue from a cash cow, which is a property industry. Now, without any further ado, let's concentrate on the section 24. And I must say, before I proceed, the amount of fooha this particular section has created within the property industry, I don't think any other legislation has managed to create, and this has been historical till date. So simply what it says is, and it's in a phased manner, it has been implemented since 2017-18, it has been fully implemented in the current year. What it simply says that it not require rocket science to understand is that if you were to rent a property out and have your rental income of £1,000 and your mortgage costs were to be 400, a child could calculate 1,000 minus 400 is 600 is a net profit, and this is on the net profit is what you should be paying your taxes on. HMRC started saying no, you can no longer deduct your £400 from £1,000 rental income. That means your £1,000 will be subject to income tax directly. At the same time, the £400 that is there that you could no longer deduct, that they would allow you to deduct, but only at the basic rate band of 20%. So the idea is to put you into a higher rate bracket of 40% and thus to give you a basic rate relief at 20%. So almost half, about 50% chunk additional can be taken in terms of taxation. It's a very smart and cunning way of collecting the taxation, but hey ho for that. This is where we live in, that's the industry and that's the economy we live in currently. So yes, we can no longer deduct the mortgage cost. So increase in profit means increase in tax. We all need to do something about it, absolutely. But there cannot be a one size fits all. And I'll come to that later on as well. But at the same time, since we've seen the increase in mortgage cost as well, it seems like, yes, you can no longer deduct the mortgage cost, but at the same time, mortgage costs are going up as well. So it's kind of a double negative. But what if I were to say that, let me give you the good news first before the bad news. It's the fact that Section 24 does not affect everybody. Now, you may be thinking I've had enough throughout the day and I'm looking forward for the weekend. And that's the reason I'm saying so, but that's not really the case. And I'll prove it with the example as to why I would say the Section 24, the interest cost can no longer deduct everybody. So it would affect larger majority, but not everyone. What I meant by that is as long as your total income is up to 50K. So if I were to work in Tesco on 25K salary, and then if I were to have 2 buy-to-lets and I'm having the total rental income, gross rental income of say £8,000 per month, coming to £24,000 per annum, my total combined employment and property income comes to less than 50K, about 48K or so. In that particular instance, Section 24 would not affect me. What I meant by that is that I can still deduct the mortgage cost from my rental income. It sounds too good to be true. It seems like I have just lost it completely, but that's not the case. Let me go through with the examples to you. So on the left-hand side, you have a basic rate taxpayer whose income is up to 50K, and that's where the key is. The key is to have your tax planning to the extent that if you have some other family members within your family, such as your spouse, your children, who are over the age of 18 and has got lower or no income, a family partnership could be a great way of mitigating the Section 24, but I'll come to the tax planning side later. So for the easiness and to have a clear, unbiased view of the comparisons, we have got on one side a £40,000 income and just simply multiplied it by 80K on the higher rate side of it. The mortgage cost is 10 and has 20 on the other side. Now, before Section 24, the legislation was implemented, and after means obviously that the fact that Section 24 has been fully implemented and you can no longer deduct the mortgage cost. So as a result, my profit before was 30K, but now my profit is remaining 40 because I can no longer deduct £10,000 worth of mortgage cost. My personal allowance would remain the same, and as a result, my taxable income has gone up. And yes, my tax has gone up from 3,486 to 5,486. However, the basic rate relief would still be applicable. So since they could no longer deduct £10,000, they're giving me a relief at 20%. That means I can still deduct £2,000 from the income tax, not from the rental income, but from the income tax. And hence, the tax position would remain the same. Magic. So as long as your gross income, including the rental income, including any other income that you want to have in the UK for a particular year, is up to £50,000, you're fine. There is nothing to worry about. It's only when your gross rental income goes above 50K is when you need to start planning, because as you can see, from 11,472 to 15,472 is a huge gap. And it would keep on having it, the gap would keep on widening it up as more the income that you would have. So that's on to those, the fact that it doesn't affect everybody. Now those into the higher ed sector, higher ed taxpayer, where they have been affected by the Section 24, what we can do about it. And as I mentioned earlier, one side clearly does not fit all as long as the tax planning is concerned. It all depends on their own individual circumstances. So please do not do any DIY tax planning and seek professional advice before you do so. We will go through with some of the tax plannings that you could do to mitigate the property taxes, and it considers more holistically rather than just Section 24, but Section 24 is equally considered. And I'll go more in detail, especially onto the property portfolio incorporation side. So what you can do to do your tax, to pay your tax lesser. One is to do something to pay tax lesser, and one is the fact that you have paid tax and you can claim it back. So to pay tax lesser, property tax planning, what you can do is property portfolio incorporation. That means you have your properties under individual name, you could transfer them into company. I would explore this further into the next slide, so I would not go more in detail, but the bulk of the benefit here, apart from having the fact that Section 24 has been covered here, because you can deduct under company, you can no longer deduct under individual or any other partnership. You can deduct in the company. The major advantage here, I would say, is the capital gains tax, because your property prices gets reflected to be the new market value as the new base value. What I meant by that is, again, like I said, we'll cover in the next slide. But portfolio incorporation for those who own 5 or more properties. Now, 5 is not really a benchmark here, but rather if you can satisfy yourself that you're putting 20 hours a week in your business managing the properties portfolio of yours, then that's sufficient enough. And hence I put perhaps give or take 5 buy to let would take at least 20 hours a week or more of your time to manage them. You do not have to manage by yourself. You could have an estate agent to manage them as well. That's fine, as long as somebody is putting 20 hours a week to manage it, to class it as a business. Then you have the smart company, stroke freezer share, or stroke family investment company, where you do it to even buy one property under company name. This mitigates inheritance tax at the same time, obviously Section 24 as well. What it means is the fact that if I were to buy a property worth $250,000 currently and keep it under the smart company structure, any increment that particular property were to see would not be subject to inheritance tax. That means if I were to die 20 years down the line and this £250,000 property becomes $2 million, the inheritance tax would be due only on $250,000. It would not be due on that 1.75 chunk of big amount million. Multiply that by 40%, it would not be due on it. So again, obviously more the amount, more the inheritance tax savings. So this is the benefits of the freezer share called smart company structure, but usually called family investment company. Then you have the interspouse tax planning. This is very standard and very, very typical, yet not many people have exercised it, whereby one of the spouse, either husband or wife, is a higher rate taxpayer. The other one is either basic rate or nil rate taxpayer. You just need to have a declaration of trust in place, transfer your beneficial interest in your property to your spouse, and then through that way the spouse would have the rental income as opposed to you, because then you would be affected by Section 24, your spouse would not be, and you are covered through that way. A simple tax planning, but again requires a bit of work done, and you obviously have to do it before the year end finishes. Then comes the limited liability partnership. This has been very, very popular these days. But before that, LLP is kind of a mini version of portfolio incorporation, whereby you are not transferring all your properties into a company name at the outset. What you're doing is you have your properties under your individual name. It could be 3 or 4, or it could be 10. You would have them under individual name. You would form another company as well under your own name to be your self-shareholder and director. And then there's this artificial partnership between your company and yourself. because company is a separate legal entity. So now all the property income goes under the LLP. The partnership account will file the property income, and then from there it's up to the partnership to distribute the rental income between the individual and the company. And goes without saying that the company would take bulk of the chunk of the rental income as opposed to the individual, and hence the section 24 would be mitigated, because as you all know, company can deduct the mortgage cost, individual cannot. Then you have the property management company. This is simplest of the tax planning that could happen, and this could happen going back even section 24 was implemented. This could happen for any property, and we used to do this since 2005 and 6 that I've seen this happening, where you have the property income, but you are a taxpayer, you're paying 40 or 45% tax on it. What you can do is form a company, transfer 15% of your rental income into the company straight away as the property management business. HMRC has accepted it, and they allowed up to 15% maximum. So with that, what you're doing is transferring 15% of the rental income to be taxed at 19% reduced corporation tax, as opposed to your higher rate of 40 or 45%. You can also obviously form a UK trust registered, which we specialize into, and with that, it not only mitigates the section 24 completely, depending on how you portray it, depending on what the beneficiaries are, but at the same time, you could eventually pay zero tax. What I meant by that, and I'll cover that part later on in the next slide, is the fact that if you were dividend from any trust, which is a UK trust particularly, is subject to a tax refund depending on the beneficiary's position. That is not quite the case with other dividend legislation such as company. If you were to receive a dividend from the company, you are subject to additional tax. So depending on your taxpayer, say 8.5% to 33.5%. But that's not quite the case with the dividend from the trust. Children and family members, they've seen many a times whether their children and family members within the family who have had no income at all and they haven't been utilized. The least you can do is utilize a personal allowance, which is 12,500 something, multiply that by 45% of your tax savings that you are hired taxpayer, or 40% tax savings comes to a huge chunk of £4,000 or £3,000 of tax savings year on year. And it's just simplest of tax planning that requires a bit of vigilance within your family itself. Last but not the least is the group structure, whereby we create a prop corp structure. You have properties under company name, but one of the advantages to safeguard your real estate, in addition to having the advantage of registering for VAT and claiming the VAT refund back, because if you were to have property under company name and you have, say, 5 properties, you're renting them out, you cannot register the company for VAT because rental income from the residential properties outside the scope of VAT is exempt. However, what you can do is form another company, lease all the property out at 85% of the market value to another company, and now your operating company starts renting the properties to the actual tenants. The advantage, yes, as I've mentioned, the VAT and other tax advantage, but also the legal advantage is the fact that, God forbid, out of the 5 properties, I forgot to put the gas safety on one of the properties, and now there's a fire. If tenant were to sue me, they could put their hands into my real estate, but now the tenant could only sue the operating company. The operating company does not have any real estate. So many advantages that goes in line with it. Now we talk about the property tax refunds as opposed to the property tax planning, where it mitigates taxes. We are concentrating on what we can the tax back. Stamp duty land tax is the big one. So this can happen at the 2 stages. It could happen in the pre-purchase or post-purchase. So pre-purchase, as in you could pay 0 stamp duty land tax if you were to buy a probate property and so on. There were 37 other sects of the reliefs that are available that can be used to mitigate the taxes or to claim the tax refund. So probate property is one of them. And then refund of stamp duty land tax, such as if you were to buy a property which happens to be a multiple dwelling, as in you have bought a bulk of flats or perhaps 3 or more property at the same time, then the rates that are applicable for the stamp duty is not the normal rate. You are eligible for a lower reduced rate. That's for the multiple dwellings. The granite relief is normally when you buy a larger property and that has got an annex associated with it. So that could be treated as a team to be two properties rather than one, and the relief is applicable there. But again, every situation is different, and mostly is applicable for the residential property as opposed to commercial property. Land and remediation is not a great one, but it's still applicable where you happen to do one of these areas of work in your part as part of a development, such as asbestos, so Japanese will not be removing. These are rather more tedious and difficult tasks, which HMRC recognizes it, and hence for every pound that you spend on, they would give you 150% back in. So again, it's not a big amount, but still something compared to having a normal amount of 100% just. And last but not the least, which is normally my favorite, which is the capital allowance. Now there's no time limit to claim on the capital allowance, and this applies to purely the fixtures and fittings that you would have purchased of a commercial property. So average, give or take, a commercial property worth say $500,000, we could claim the capital allowance on it at least nothing less than 15%. Now this is in addition to what you could account for anyway, and you would normally get this as a corporation tax refund against it. Obviously, you cannot claim against the development cost, but just to put in a layman's term, if you were to put your property upside down, what comes out is what you can claim the capital allowance. As I have promised, I will concentrate more onto the property portfolio incorporation, which is affecting the Section 24 side. If you were to transfer your properties into a company name, and as I've mentioned, 5 is just the benchmark. Please just don't come with me on the number of 5, but rather on the 20 hours or more a week that you can put into your business. The benefits that you could have by having the property transferred into company name, the biggest benefits is the capital gains tax savings. And by giving you an example, say you have bought 5 properties back in 2000 and they were worth $500,000 in total, as in 100K each. Now in 2023, they are worth 2.5 million. When you do the incorporation, the market value, the current market value of all these properties happens to be the revised base value for the purpose of capital gains tax. That means tomorrow, if I were to sell, after the incorporation, if I were to sell these properties for 2.3 million, I would pay 0 capital gains tax. And that's the biggest and the huge advantage that one can take from the incorporation. Secondly, yes, income tax savings, Section 24, you can deduct, which you can no longer deduct from the individual or the partnership. Director's loan account with the savvy tax planning, because effectively it's the individuals who are putting the funds into the company. So it's the individual's funds that they are taking it out from the company. And hence, if you are smart enough, you could actually end up paying no dividend tax because you're actually withdrawing your own funds. And again, you can multiply this and merge this with the family investments company. And lastly, the dividend distribution. I don't think I have time for the trust, but in a nutshell, just to brief it up, as I have mentioned earlier, if you were to just look at on the right-hand side on the discretionary trust, we pay 45% within the UK as a trust taxation. £20,000 was, for example, income was £9,000 the trust taxation. That's the 11,000 left over. Now, what is left over is where the magic happens here. If you were to give it away to beneficiary who's a non-UK income taxpayer, that means it could be based in the UK or overseas, but this particular person has got no other income. Then the legislation states is that HMRC would repay back the proportional amount of tax suffered by the trust to this particular beneficiary. So obviously I can give it to any Tom, Dick and Harry as long as I have got my trust in that particular person, and it's completely legitimate to do so because they are the income beneficiary, not the capital beneficiary. By giving them the dividend, we can claim the tax refund back. So forget about Section 24, whether you could deduct or not deduct. Even if you can't deduct, it doesn't bother you because you are not paying any penny of income tax on that particular property rental income as long as you have settled that interest. That's just in a nutshell of it. I hope I have made the most of your time. Feel free to scan this QR code if you have any personal questions. And as usual, Monu is ready for Surinder and Charan's questions if they have any. And for your kind information, Surinder, you are on mute.
Arif, I'm just stealing Srinder's Zoom thing. I'm not Surinder, so hopefully I'm better looking than him. But anyway, that's a question. Thank you for that really interesting presentation. Charanjit, any questions? You're probably muted as well.
Oh, hi. Yes. Thank you for that, Arif. That was really enlightening. I mean, there's an awful lot there to digest, to be quite honest. And I think, yeah, I think it's like you said, one size doesn't fit all. So really, it is down to your individual situation, isn't it? And how the increase in interest rates is impacting you.
So I've got a question. So if I'm right, if you're earning, including your rental income, if you're earning less than 50,270, you're okay.
Yeah, I mean, give or take, I mean, I would say 50K. If your total income is 50K, including rental income and including any other income, you're fine.
You're fine. But if you're a higher rate taxpayer, and this is the conversation we were having before we got on air, if you're a higher rate taxpayer, you're going to have to pay more money for your interest, and also you're going to have to pay more tax. Is that right?
Yeah, absolutely. So if you hire a taxpayer, you have to do something about it. So either you should go, if you have a good chunk of portfolio of properties, such as 5 or more, it's a no-brainer not to go for the property portfolio incorporation. But even if you happen to have 1 or 2 properties and your full-time employment is 100K or more than 50K, you should just have a basic simplest tax planning of LLP structure, whereby you have transferred all your properties under partnership, and then the partnership gives the income to the company itself, so that you can at least get outside the section 24, and you can get the section 24 deducted in the company. So that's the least you can do, but you have to do something.
So let me try and understand, because that's a new one on me. I did that one didn't click to me before. Yeah. So you have a company and you create an LLP with a company, and you give all the income to the company that can then deduct section 24 tax. Is that right?
Yes, yeah. So it's a temporary solution. It's not for permanent. So you happen to have all the individual properties under your own name, but then the company and yourself becomes partners, and company becomes a managing partner, and company comes in as a managing partner. You comes in as a capital partner. So it's, like I said, artificial. And then as a managing partner, there's a full flexibility of how much you can give to your managing partner, and you could potentially end up giving up to 80 to 90%. You should not give 100% because HMRC would not like it. But up to 75 or 80% is what we normally go for, is what you can transfer into companies. So by us transferring that for that particular year, so of course, if you're transferring rental income, you can deduct the mortgage cost associated with it as well.
And why did you say that's a temporary solution and not a permanent one?
Because it's just a partnership which is between yourself and the company. Company does not own anything. Company is just coming as a managing partner in capacity of, you still happen to own the properties under your own belt. So okay. When you do the property portfolio incorporation, you are actually physically transferring all the properties, title deed, and the company name. Eventually it will get transferred one day or the other. Here it doesn't get transferred. It's just there for namesake, for artificial reasons.
So Arif, sorry to interrupt you, but what you're saying is then for the company, then there's nothing on the balance sheet. There's no assets on the balance sheet because the assets are still owned by.
Absolutely.
Yourself.
Absolutely. Company doesn't own anything. Okay.
And the other thing you mentioned was the ability to do an interspouse transfer, right?
Yeah, so interspouse, now this is very delicate. I mean, majority of the time people do the DIY tax planning where the property is jointly owned, and then they say, okay, no, all my income goes to my wife. It doesn't strictly work that way, because where the properties are jointly owned, we are not talking about interspouse tax planning there. Because if they're jointly owned, by very nature, they're jointly owned anyway. You can't, now, we are going a bit more legal here, where they're jointly owned. If they're jointly owned, as how? Joint tenants or tenancy in common? If it's joint tenants, it's inseparable. That means if something is owned between husband and wife and husband dies, everything becomes the rule of survivorship will kick in, and then wife would happen to have the entire property. But if it's tenancy in common and husband dies, husband's share dies with his own death. That means husband can have and say that my share of 50% can go to XYZ. So if you were to give your share to your wife, then you have to see a joint tenancy to tenancy in common, which majority of the time people don't do. What we were talking about, the inter-spouse tax planning, is not the fact that property is jointly owned. Property is owned just by myself under my name. I have signed up a declaration of trust whereby I have given the beneficial interest to my wife, and hence my wife can then get that chunk of rental income into her tax return as opposed to myself. But again, HMRC needs to be notified, and you can't do a DIY here because there would be inevitably some mortgage cost involved, and you can't transfer what is owned by the mortgage lender. So careful planning is required to happen, but with some careful tax planning, you can transfer some of the income or perhaps bulk of the income to your spouse or to anybody who is non-earning taxpayer. Now, spouse for a reason, because any transfer between husband and wife is subject to no capital gains tax. And I don't want to bombard you more with taxes, otherwise, and I'll keep on telling you Surinder, because that's how the name will appear, and I will make you embarrassed the fact that Surinder is not here. But in essence, any transfer triggers at least 3 taxes. We use spouse because there is the transfer between husband and wife happens to be at no gain, no loss for the purpose of capital gains tax. That's only between husband and wife. Any other person or entity would trigger capital gains tax. So we have tackled capital gains tax. We know there is no capital gains tax by giving it to your spouse. We just need to make sure there is no SDLT by ensuring you only give to the extent of your equity, because obviously you can't give what is owned by the banks or the lenders.
Charanjit, any response to that?
I know it was a bit too much to handle, but it was there for a reason, so that you don't then you can call me later and I can charge you for it.
Well, are we going to negotiate a deal for our viewers?
But yeah, there are many things that can be done, and ideally should be doing it. On a selfish note, anybody who's earning more than 50K, they should be thinking about their tax planning.
Think about it, do it, take action, because if you're earning more than 50K and you've got rental income, it's going to cost you some money, right?
Absolutely. It will, and it will keep on cost you more, because even if you were to have a company structure, I mean, you must have heard the fact that 19% has gone up to 25% as much as once your profit goes more than 50K. I mean, for me, more than 50K is an average profit that a normal businessman would make. And that's where the corporate tax rates would go up. So, I mean, tax plan is required every left, right, and center, as long as you want to pay lesser and you want to be in compliant and be a good abiding citizen within the UK.
Yeah, and it's perfectly legal to plan your tax affairs, right?
Absolutely. There's a clear distinction between the tax planning, as in the tax planning compared to tax avoidance, and even the tax avoidance compared to tax evasion. So tax avoidance are some schemes which I would not recommend going into, and tax evasion, obviously, as we must have heard, is illegal to do so. So yeah, 3 parameters, always stick to tax planning.
Right. Before I come to my last question, Charanjit, any more questions? Because we're going to let Arif go early. You can have time off for good behaviour and a great presentation.
Yeah, Arif, can you quickly say something a little bit more about the family investment company or smart company or freezer shares? Because
yes, yeah. So that's one of, again, my favorite one as well. So family investment company, it can be utilized while you're doing the incorporation. So if you were to transfer properties from individual name into company name, you may as well have it structured as a family investment company. Or even if I were to buy a new buy-to-let property tomorrow and I want to buy it under a company, rather than just buying it in a £13 company from the company's house, get it a family investment company, whereby the company structure has been, the share classification has been structured in a way that there are several classes of shares. The class A would be yourself, whereby you are the one who's introducing the capital. Class B, C, or D could be the shares whereby you are transferring the growth occurring to that particular company. So if you were to buy a property worth 2.5 million, 2.5 million, assuming no mortgage. So 2.5 million is mine. That's my capital. That's fine. You can't deny that. But from 2.5 to 3.5, any growth occurring can go to the class B, C, or D. And that particular class can then be further structured within the trust so that anybody can be added as a beneficiary to that particular class B, C, or D. And hence, that growth is no longer part of my estate, but part of my beneficiary estate. It could be my children, it could be my spouse, or it could be my girlfriend, or any person for that matter. So hence, when I die with only 2.5 million. I do not die with the market value on the date of my death. Advantage number one, which is the inheritance tax. And it's the biggest advantage, inheritance tax. Number two, when I do the company incorporation, I can a bit more smarter way the shareholdership and the directorship side as well. 5 years, 3 years down the line, the growth would occur and the class B and class C would have some value within. Now, if the beneficiary were to be my children, I can give some dividend to my children as well. The reason of me giving dividend to my children who are obviously over 18 or my spouse is the fact that I'm a higher taxpayer. If I were to take a dividend, I could be subject to 33.5% or 30.1% dividend tax. They could be subject to 7.5 or perhaps zero tax if they've got no dividend at all whatsoever.
Right. Thank you for that, Arif. I'm gonna ask you the last question, but
I know what the question would be, but yeah.
Yeah, you know what my question is going to be, right? Before I ask that, will you come back and do a presentation just on smart companies? Because it sounds really interesting, right?
Yes, yeah. That's the topic really that requires a presentation on its own. Yeah, would love to.
Right. So come back and do that. And my last question is, why haven't you put your name up with your Russian alphabet behind it?
Because everybody, I'm such a known personality now, thanks to your good words. So I thought I would just rather have my humble company's detail on, so that those who want to have questions, they can scan the QR code.
All right. Scan the QR code, ring him up, send him an email, and ask for his full letters with his God knows how many letters you've got behind your name. Like they seem to. You had to knock a few off, didn't you? Because you had so many. Yes,
yeah. Just along with the letters that knocked off my hair as well. So yes, I've lost some with that.
Yeah, I thought you looked different today.
It's no prize for one, right? All right, Arif, we won't keep you. Thank you very much for taking out your valuable time. Really interesting lesson. Just to sum it up, if you're a high rate taxpayer and you're getting hurt by these interest rates going up, there's another bit of bad news coming, which is your tax. Go and see Arif. Arif, put your slide back up, please, if you don't mind. And we'll hang on a minute. What's going on? Right. And we'll have you back on a show in future. So thank you very much, and everybody else. We're all going to disappear now because we're having half day now. All right. So thank you for your time. Please watch this back. It's on YouTube. Likes the usual stuff, because that's how we got to pay the bills. But so it means we could get even more time with Arif in the near future. Thank you very much, and